Day trading vs swing trading. What's the difference? Day trading and swing trading are two strategies worlds apart. Know the difference and don't assume it's just a matter of trading frequency and time. Every trade or investment is based on the same precept: buy low and sell high. That's the one thing that ties together day trading, swing trading, and long-term position trading. But aside from this one precept, each style has enough differences that a trader specializing in one might find himself completely unfamiliar with the other. But how different can it be, really? Isn't it just a matter of ramping up your trading frequency, going for shorter profit targets, and limiting or expanding your trading duration? Yes, it is. And by virtue of those three things, day trading is a completely different practice from swing trading. If you've tried both, you probably know that day trading isn't swing trading sped up, and swing trading isn't day trading slowed down. If you switch domains without changing your approach, you might fail to maximize your opportunities. If you're not familiar with the differences, then read on. That's what we're going to cover here. So let's dive in, starting with the first and often overlooked factor: volatility. The smaller the scope, the greater the volatility. If you're a high-frequency day trader aiming for small profit targets, say 5 to 10 ticks, you often have to take larger positions to make your ticks worthwhile. How large a position you should take depends on many factors, but let's save that for another discussion. The cost of missed trading opportunities. One of the most obvious key differences between day trading and swing trading is trading frequency. Day traders can trade multiple times intraday, while swing traders can keep positions open for 1 to multiple days. The cost of missing a trade can be substantial, either missing out on a big winning trade, thus lowering your overall returns, or missing out on a big losing trade. But since we do our best to limit our downside by placing trades with favorable reward to risk ratios, adequately sizing our positions, and using stop losses in addition to loss limits, we're more worried about missing a winning trade that might have significantly raised our overall profitability, rather than a losing trade whose negative return could have been capped by virtue of a stop loss or loss limit risk management strategy. The more you trade on an intraday basis, the easier it is to miss a trade. Think bathroom break, phone calls, kids, meals throughout the day, etc. What about missing a swing trade? The cost of missing a swing trade can be equally harmful. However, the chances of missing a swing trade can also be less likely. If your swing trade has a longer trade span, say a day or more, it's harder to miss simply because you might have plenty of opportunities to enter the trade. Even if you miss the initial entry point, time is even more forgiving for long-term positions which last weeks to months. This may shave off points from your potential profit or loss, but since your profit target may be days away, you might still have a chance to enter the trade relatively early on. In contrast, day trades can have a much shorter trade span. From seconds to minutes, miss your entry, and you may miss a large chunk of your profits or losses. The main point here is that the cost of likelihood of missing trades is greater for intraday trades than it is for swing trades that span multiple days. Converting demo performance to live performance. Here's a quick note on converting demo to live performance, as this is typically what beginning traders do to measure their readiness for a live market. Let's try a simple thought experiment, though you've probably already done this yourself using a demo and live account. You make 100 demo scalp trades, all aiming for short profit targets of a few ticks, and you succeed in most of them, yielding profitable results. You, demo, trade on pen and paper 100 long-term position trades, say in the stock market, yielding profitable results at the end of the year. Which profitable demo scenario is likely to have produced similar results in a live market? The second one, of course. Since demo trades can't accurately simulate the supply-demand forces of a live market, the shorter your time frame for trades in a simulated environment, the less accurate your results. For instance, you may not get filled in an ultra-short-term scalp, your slippage may be horrendous, and compounding trading costs can quickly erode your profits or add to your losses. In contrast, when demo trading a longer-term position, the forces of intraday supply-demand are less of an issue, making your simulated results more aligned with your live results. The main point is that if you're looking to jump from a simulated market to a live trading scenario, larger your profit target and stop loss, the closer your simulated results may be to reality. Scalpers who attempt to convert demo to live often get burned right away, only then do they realize how different the live market is from a simulation. A tactical versus strategic environment. The narrower your trading time frame, the more market noise you have to deal with. If you're scalping the market, chances are you're trading a lot of noise, looking for quick, tactical setups to exploit near-term supply and demand, which may or may not have a meaningful connection to the larger fundamental forces shaping the market. Differences in trading time. Can you handle sitting in front of your computer waiting for trading opportunities day in and day out? It's one thing to sit at your desk working on a project, say for work. It's quite another thing staring at your trading screen paying attention to most, if not in market movement. Day trading not only requires more focus, it's arguably much more exhausting than swing trading. Many swing traders work off the daily charts. This gives you plenty of time to analyze and execute your trades. It can also be less stressful. You set your risk and profit scenario and you let it play out. If you swing trade the 1-hour charts, then yes, it'll take more time, but it's still relatively less stressful than watching your screen for hours on end every single day, hoping not to miss a trading opportunity. Since swing traders are focused on the bigger picture, they're less burdened by second-to-second changes in the market. They're able to use technical and fundamental tools to identify potential opportunities in a timely yet less rushed manner. Day traders who often and willingly engage supply and demand at a noise level can't whether it has lasting significance in shaping the market or not. It's a be quick or be dead mentality. It takes lots of more time, lots of more focus, and the price of your time and energy investment ought to be worth it. Otherwise, you're taking on more risk more frequently for a payoff that may or may not be worth the cost. So think long and hard about this and try both before dedicating your focus to either one. Focus, research, and experience. As we said early in this article, and it should be evident by now, day trading is not swing trading slowed down, and vice versa. For example, just because you're trading the same chart pattern, say, a symmetrical triangle in either scenario, doesn't mean that the difference between the two is in scale or frequency. There are major differences in the market, time, environment which require a difference in approach. Let's go deeper and look at both approaches as something of a one requiring its own unique level of focus, research, and experience. Remember that successful day trading or swing trading requires time, repetition, and the experience of both success and failure. Developing an edge in either case requires dedication, something you can't achieve unless you master one or the other, at least in the early stages of your trading career. For instance, there's a certain level of tactical flexibility and time inflexibility that day trading requires. If you're trading a scenario that's noisy, you might have to switch your setups because, after all, the event you're trading ultra short-term supply and demand imbalances may be occurring at the noise level. This differs in swing trading, where your trade setup may be based on a larger supply and demand scenario or on fundamental data or expectations. There's an inflexibility with regard to day trading, namely, you can't afford to leave your screen for too long, as you may miss a trade. In swing trading, you don't necessarily have to be at your screen once your trade has been planned or executed. Swing trading may require near-term fundamental analysis in order to get a strategic view of the context. Day traders just have to know when big events are happening, i.e., FOMC announcement, GDP report, etc. But beyond that, day traders are masters of minutiae, and the more skillful ones can make a living trading small and sometimes insignificant market fluctuations. In short, the difference between day trading and swing trading goes much deeper than just time frame alone. Both are completely separate disciplines that have their own requirements and their own rules of engagement. Ultimately, deciding between the two depends on your own personal tendencies with regard to physical and mental stamina, reflexes, risk tolerance, capital resources, and your personality. Capital requirements may vary. There are varying requirements for different asset classes and markets. For instance, if you're interested in day trading stocks, you'll need a minimum of $25,000 to be a pattern day trader without being penalized. In the case of equities, swing trading may be more suitable, especially if you don't have an extra $25,000 to add to your account. This isn't necessarily the case in the futures market, though you have other funding challenges to consider. Competitive day trading margins can allow people to day trade contracts such as the mini S&P 500s for as low as $400 per contract, but to hold a position beyond market close, as swing traders often do, you may need upwards of $12,000. Not many. Fortunately, the CME now offers micro, a mini contracts a tenth of the exposure to the standard M&S so that an equivalent contract M MES would require only, say, $100 to day trade and $1,200 to hold overnight. In addition to capital requirements, another thing to think about is whether you can afford to trade at the frequency at which you plan to trade. For instance, we know that trading cost, commissions, and slippage can eat away at your profits and add more to your losses. In light of this fact, can you afford to day trade, say, 5 times, 10 times, or 20 times or more a day without depleting your trading account? Something to think about. The bottom line: day trading and swing trading are two separate disciplines whose differences are to be found not only in their respective markets and time frames but also outside of the trading window. Stamina, research, capital requirements, and everything else we discussed above. Before you decide on one and the other, be sure to give it plenty of thought and perhaps try your hand at both. In live market, simulations don't really count at this stage of the game. Ultimately, it boils down to your personality and which style resonates with you the most. Be honest with yourself and capitalize on your strengths first before buffering up your weakness. In time, you'll find what's more natural to you, and once you do, that'll be the start of your path towards successful trading.